Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward.
Yeah.
Today, we're diving into Chipotle Mexican Grill, trading under the ticker CMG.
Chipotle is currently a coiled spring in the fast casual sector, executing a high-stakes pivot to functional fuel snacks and aggressive share buybacks at distressed valuations.
Wow.
Yet this recovery hinges on its ability to maintain a value moat by absorbing inflationary costs without alienating a macroeconomically squeezed core demographic.
That thesis statement,
Yeah.
it really captures an almost impossible tension.
Mm-hmm.
On one hand, you have this, best-in-class operational engine, a brand with immense loyalty. But on the other, that engine is kind of sputtering because its most important customers are suddenly, well, they're broke.
They are.
So this deep dive is really about understanding if management strategy, which involves a massive near-term financial sacrifice, is brilliant or if it's just reckless.
It's definitely high stakes. And to understand the solution, we have to start with the problem,
Right.
which falls entirely under our strategic analysis, the value and volume pivot. This is where we really define the scale of the crisis they're navigating right now.
Okay, let's unpack this then. We've been talking about consumer strain for months on this show. But when you look at Chipotle's data, it's not abstract at all. It's highly specific. Can you walk us through the scale of this financial pressure, this thing we're calling the grocery shift?
The numbers are frankly shocking for a growth company of this caliber. The consumer cohort with household income below $100,000 represents a massive 40% of Chipotle's total sales.
40%, wow.
Think about that. Nearly half of all their revenue is dependent on the spending habits of the demographic that is most sensitive to inflation, to student loan debt, to slowing wage growth.
So when the macroeconomy tightens,
The Chipotle feels it instantly.
that is a massive number.
Yeah.
But the behavior we're seeing isn't customers trading down to, say, a McDonald's dollar menu, which is what you normally expect when budgets shrink.
Yeah.
The behavioral shift here is much more painful for the entire restaurant industry.
It is. Management has been meticulous in tracking this, and they've stressed repeatedly that these core customers are not defecting to competitors. They're performing the grocery shift, moving consumption entirely to grocery and food-at-home options to save money.
So the competition for that 40% isn't Taco Bell.
No, it's the refrigerated aisle at the local supermarket.
It's the difference between a slight erosion of market share and a complete contraction of the whole spending category. I mean, when you choose to eat at home, you save significantly more than switching from a $12 burrito bowl to an $8 competitor meal.
It's an absolute contraction of the dining out wallet for this crucial segment.
Right.
And this leads us to the critical identification of the particularly challenged cohort inside that 40%. The pressure is highest on the 25 to 35-year-old age group.
And that single segment.
It accounts for roughly 25% of total sales, a quarter of the entire business.
That's striking. Why are these young professionals, who are typically the heart of the fast casual segment, why are they facing such unique pain right now?
They are facing what you called earlier a perfect storm of headwinds. First, they have higher unemployment rates compared to the general population.
Okay.
Second, and this one is massive, the resumption of student loan repayments has just vacuumed up significant amounts of discretionary cash flow.
The cash that previously went toward.
Things like, well, a Chipotle lunch.
Yeah.
And third, their real wage growth. So wage growth after you factor in inflation, it's been slower relative to the costs they face.
So they're getting hit by debt, high rent, and stagnant spending power all at once.
Precisely.
When you combine those factors, it makes perfect sense that the first casualty is that high-frequency discretionary purchase. And we see the direct result of this pullback in the financial data. The hard data point that validates this macroeconomic pain is the transaction impact they reported in Q3 2025.
Correct. That transaction pullback resulted in a negative 0.8% decline in total transactions for Q3 2025.
And that's the indicator that the frequency engine has stalled.
It is. In the restaurant business, traffic is everything. Growth is easy when frequency is rising, but when you hit negative transaction numbers, that's a red flag.
But, and this is what's confusing, we see this counterbalance. The average check still managed to increase. It showed a 1.1% lift.
And this is the paradox of their current strategy. It suggests two things. One, the customers who could still afford to dine out were maybe ordering slightly more premium items or adding sides.
So the higher income cohort is stable.
Seems to be. And two, management took some minimal, very strategic pricing actions, which contributed to that average check increase. But that 0.8% transaction drop, that's the truth teller. It confirms that tens of thousands of their most loyal, budget-conscious customers are simply coming in less often.
Which catapults us right into the second strategic conflict here. The price perception gap and the value mode. You hear customers complain all the time about how expensive Chipotle is, yet the data tells an entirely different story.
It really does. Chipotle's value proposition is objectively strong. They are currently delivering food at a 20 to 30% discount to peers in the fast casual category.
A 20 to 30% discount.
Yes. When you compare the quality of ingredients, the generous portions, the culinary prep using fresh ingredients daily against a competitor in that $15 average range, Chipotle is significantly cheaper.
So why the complaints? Why does everyone feel like they're spending a fortune there?
It's what management has identified as the perception lag. Customers, especially those budget-conscious 25 to 35-year-olds, they incorrectly lump the brand into that $15 average competitor category.
So their perception is just built on, what, one bad experience or anecdotes?
Pretty much. And that perception scares away low to middle income diners before they even walk through the door.
The average entree price is closer to $10, right?
Yeah.
But the brand is viewed as unaffordable by a large portion of the market, according to their own internal surveys. That's a massive communication failure, not a product failure.
It's extremely difficult to correct a perception gap, especially in an inflationary environment. If you run an ad saying our average meal is $10, people assume you've cut quality.
Right.
And if you highlight the quality, they assume the price must be high. Management even tested campaigns highlighting abundance and quality, intending to communicate value.
And what happened?
Consumers focused only on the quality, and they missed the price message entirely.
Okay, so if they can't simply advertise their way out of this, they have to execute a much riskier, more tangible strategy. And this brings us to management's strategic trade-off, which seems designed to physically and tangibly reinforce that value proposition.
This is the absolute core of the Coiled Spring thesis. They made the specific and highly aggressive decision to not fully offset expected mid-single-digit tariff inflation and rising beef costs in 2026.
So hold on. That's a deliberate, calculated decision to sacrifice near-term margins to win a long-term value battle. That sounds incredibly risky. I mean, if costs are accelerating, especially beef, which is a massive commodity input for them, and you refuse to raise prices to cover that, you're essentially agreeing to a pay cut on every single burrito you sell.
That's precisely what they're doing. They anticipate inflation accelerating into the mid-single-digit range in 2026. By absorbing those costs, they are purposefully pressuring near-term margins. This isn't short-sightedness, it's an investment.
An investment in what? Perception.
An investment in correcting that perception lag. If they hold their price steady while every competitor around them raises theirs to offset the same inflation, the consumer perception will eventually realign with the reality of that 20 to 30% discount.
Let's quantify that tariff headwind risk, specifically from the Q3 2025 results.
Okay. In Q3, tariffs already negatively impacted their margins by 30 basis points. That's 0.3%.
And a basis point, for our listeners, is just 1/100%. So 30 basis points is a tangible reduction in profitability just from tariffs.
It is. And the expected future pressure is even higher.
How much higher?
Management estimated that the ongoing negative impact will settle around 50 basis points in 2026. So 0.5%. And this figure specifically excludes USMCA imports, so tariffs from Mexico or Canada don't even factor in.
So that's 50 basis points of pure, self-imposed margin pressure they are choosing to absorb, all to protect this value mode.
That's the plan.
This strategic decision is the linchpin then. They're betting that the temporary pain of margin compression is worth the long-term reward of regaining frequency and volume from that 40% cohort. But they can't just stand still waiting for the economy to cooperate. They have to give that stressed consumer new reasons to visit.
Which brings us to the critical section on innovation.
Right.
This is where management gets highly creative, really pivoting away from the traditional fast casual model. The game isn't just about selling burritos anymore. It's about selling convenience and nutrition.
Which we see in what they're calling the pivot to functional fuel and snacking.
Exactly. And the centerpiece of this pivot is the introduction of the 4-ounce meat cup snack, priced very affordably at an average of $3.82.
The meat cup. It's a strategic masterpiece in its simplicity, isn't it? It's not just a new product, it's an entirely new competitive positioning.
You're right. They are moving beyond selling only complete meals to selling nutritional components. A 4-ounce serving of high-quality protein at under $4 is designed to solve several problems at once.
Let's talk about the strategic intent behind this. It's clearly aimed at more than just a quick bite.
Oh, absolutely. The first intent is to monetize the off-peak shoulder periods, the slow times between 2 p.m. and 5 p.m. when the lunch rush is over and dinner hasn't started yet.
It drives foot traffic when the kitchen is underutilized.
Generating incremental sales with minimal extra labor cost. And the second intent is that shift in competition. They are now competing directly with convenience stores, protein bars, and protein shakes.
This is where it gets really interesting to me. They've transformed the brand from a meal destination into more of a nutritional charging station.
That's a perfect way to put it. When you compare a $3.82 meat cup to a $4 energy bar or a $5 convenience store protein shake, the meat cup offers far superior value, quality, and flavor.
It transforms that budget-conscious 25 to 35-year-old's decision process. Instead of skipping lunch entirely, they can grab a cheap, high-quality protein hit.
Exactly. And this product is also perfectly timed to capitalize on these new diet trends, specifically the booming interest in high-protein living.
The launch of the high-protein menu.
Yeah.
That's the other side of this coin.
Yes. Featuring curated bowls, specific combinations ranging from 15 grams up to a staggering 81 grams of protein per serving. It's an acknowledgement of two monumental dietary shifts happening right now.
Let's start with the most talked about shift, the rise of GLP-1 users.
Right. So people using weight loss medications like Ozempic or Wegovy have a significantly suppressed appetite. They need smaller food volumes. But, and this is key, if they don't consume enough protein, they risk losing critical muscle mass along with fat.
So the meat cup and the smaller protein-dense bowls give them that nutrient density without the bulk of rice or beans that would make them feel overly full.
Chipotle is effectively designing its menu to be GLP-1 compliant. It's making itself an essential utility rather than just an indulgence for that group.
And that same thinking extends to the broader lifestyle dieter, paleo, Whole30, high-protein, low-carb. The kind of customer who previously had to go through a pretty complex, friction-filled ordering process to customize their bowl.
By clearly marketing these high-protein options, they remove all that friction. If high protein is the top diet pattern in the U.S., with 70% of Americans prioritizing protein, Chipotle is making it extremely easy for those customers to stay loyal.
They're saying, we get it, we built the menu for you.
It's all about maximizing frequency by lowering the cognitive load of ordering.
Okay, so menu innovation is powerful, but it means nothing if the line is slow or the food prep is inconsistent. They have to back this pivot up with serious operational muscle.
Which brings us to operational engineering for throughput, the high-efficiency equipment package, or HEAP.
HEAP. This is the physical manifestation of their commitment to volume, right? It's designed to fundamentally debottleneck the kitchen and drive what management is optimistically calling a step function change in throughput.
Faster lines, higher capacity, and crucially less stress on their teams during peak rush hour. That's the goal.
As of late 2025, HEAP is in about 175 restaurants, but the full system-wide retrofit is expected to take 3 years. That's a massive capital expenditure.
It is, and the benefits have to justify that cost. The star component that everyone is talking about is the dual-sided planchas.
Okay, let's dwell on this for a moment. Why are the planchas so revolutionary?
Because they directly address the biggest bottleneck on the entire line, cooking the meat. The dual-sided planchas cut chicken cook times from a cumbersome 12 minutes down to just 4 minutes.
12 minutes to 4. That's a 66% reduction for their highest volume protein.
It's more than a mere efficiency game. It's a complete restructuring of the kitchen's flow. Think about the capacity. During the lunch rush, if you run out of cooked chicken, the line just stops.
But if you can cook 3 times as fast.
You significantly increase your morning prep capacity and ensure that even during the heaviest traffic, your teams are keeping up. Shorter lines, better customer experience. That improved throughput is the definition of leveraging their physical footprint.
And beyond the planchas, they're also rolling out a 3-pan rice cooker and a high-capacity fryer. What are the benefits there?
The benefits are pervasive. It's not just speed. It's improved labor efficiency, it generates yield savings, less burned product, and maybe most importantly, it ensures better culinary consistency. Field feedback has been overwhelmingly positive.
Now, speaking of making the job better, we have to look at an operational hurdle that was causing some customer dissatisfaction, refocusing on digital accuracy.
Right, this is a classic case of misaligned incentives. Management said a decline in digital order accuracy was due to incentives that focused too heavily on on-time metrics, speed above all else,
So teams were rewarded for getting orders out fast.
which inadvertently led to carelessness in the final check.
I love the anecdote they shared to illustrate this point because it's so relatable for anyone who's ordered digital pickup.
It hits home perfectly. If you're 5 minutes late but everything's in the bag, it's not that big of a deal. If you show up 10 minutes early and my kid's quesadilla is missing, now we have a real problem.
That one small mistake ruins the entire dinner experience.
It erases any goodwill you gained with speed. The solution seems obvious in hindsight, but difficult to implement. They had to reset quarterly bonus incentives to prioritize digital order accuracy and the overall guest experience.
They're explicitly telling their teams that accuracy trumps speed in the digital channel.
Yes, aligning team behavior with what the consumer actually needs. An accurate, high-quality order. For that budget-conscious customer who's already stressed about spending, getting the wrong order is a huge friction point.
It could cause them to lapse right back into that grocery shift.
Exactly. Fixing this is critical for frequency.
So we've covered the demographic challenge and the internal solutions, value protection, innovation, operational engineering. But to really validate management's core thesis, that this is a macro problem, not a Chipotle problem, we need to look at the competitive landscape.
That's right. When you're dealing with a business slowdown, you have to determine if the tide is going out on everyone or if your ship just has a leak.
And benchmarking against peers provides that crucial context. Let's start with a direct comparison. The new meat cup versus the price ceiling of the category, represented by Sweetgreen.
Sweetgreen clearly defines that premium tier. We see it in their offerings, specifically the $21.45 Power Max Bowl.
$21.
To be fair, it features a staggering 106 grams of protein, but that price point is the strategic anchor for the whole industry.
The contrast is phenomenal. You can get 5 Chipotle meat cups for the price of one of those premium competitor bowls.
It dramatically underscores the difference in strategy. Both brands are leaning into the high-protein, functional fuel trend, but Chipotle is doing it by aggressively lowering the financial barrier to entry,
Making sure even the most stressed consumer can still afford a product.
while Sweetgreen, conversely, is focusing on the highly affluent food as performance demographic that is willing to pay over $20 for lunch. This contrast strengthens the thesis that Chipotle is intentionally holding the line on price.
And the competitive landscape also provides crucial validation of macro headwinds. The pain Chipotle is feeling is amplified across the sector.
Just look at Sweetgreen's struggles. They are confirmation that this is an industry-wide tide going out. The salad chain had a significant 9.5% comparable sales decline.
And an even more painful 11.7% drop in foot traffic in Q3 2025.
That is crisis territory. If Chipotle's negative 0.8% transaction decline is a warning sign, Sweetgreen's numbers are a full-blown alarm.
And their reaction has been a telling strategic retreat. They sold their robotics unit, Spice, for $186.4 million. This was supposed to be a flagship initiative.
That move is symbolic. It implies a realization that bleeding-edge automation won't fix a traffic problem driven by affordability. They're shedding a massive capital-intensive project to solidify their core.
Which is a very different path from Chipotle, which is installing HEAP equipment that enhances the human worker rather than trying to replace them.
A very different path. And the validation doesn't stop there. We also see what you called Kava's echoes, which pinpoint the exact same source of the pain.
Right.
The CEO of Kava, another strong, healthy, fast casual concept, has also pointed directly to that same 25 to 35 age cohort weakness as a significant cause for their slowdown.
So when 3 major players, Chipotle, Sweetgreen, and Kava all identify the exact same budget-constrained younger consumer group,
it ceases to be a company-specific problem. It is irrefutable evidence that Chipotle is dealing with an external macroeconomic challenge.
this shared pain and validation must give management the confidence to proceed with what looks, on paper, like an extremely aggressive strategy.
Both operationally and financially.
Let's pivot now to capital allocation and the growth engine.
Given the temporary dip in stock valuation caused by this slowdown, management made a clear pivot toward the bet-on-self buyback strategy. They shifted from standard, predictable quarterly buybacks to a much more aggressive, opportunistic approach.
How aggressive are we talking?
They authorized a massive $1.8 billion multi-quarter buyback. That's a screaming signal of confidence from management that the stock is cheap.
Wow.
And year-to-date through late 2025, they repurchased $2.3 billion worth of shares.
And we know the average price of those Q3 repurchases was $42.39 per share.
Right. Given that the stock had decreased nearly 45 to 50% from its peak, management is opportunistically using its strong, debt-free balance sheet to aggressively shrink the share count.
They're essentially saying, the market is mispricing our long-term earnings power, so we will buy back our future growth at a discount.
They are viewing their own stock as the best inventory they can possibly acquire.
So on one hand, they are sacrificing short-term margins by absorbing inflation to keep customers. On the other, they're using capital allocation to deliver shareholder value by shrinking the share count while the stock is depressed.
It's a powerful, two-pronged approach that optimizes for the inevitable recovery.
And they're coupling that financial engineering with a continued, relentless focus on physical expansion. This is the accelerated store expansion and Chipotle dominance strategy.
Despite the traffic headwinds, they are accelerating growth. That takes courage.
It does.
They're showing zero hesitation. They plan to accelerate openings to 370 new stores in 2026, which is up from the 345 they expected in 2025.
And this acceleration is entirely dependent on the success of the Chipotle model.
It is. Over 80% of new company-owned restaurants will feature the Chipotle digital drive-thru format.
And why is that format so vital?
Chipotlanes are strategically vital because they drive higher margins and better returns than traditional units. They encourage digital ordering, which is often a higher ticket, and they improve throughput by separating digital pickup from the main line. They are the future of the brand.
Let's talk about the specific unit economics that justify this.
The metrics are industry-leading. New stores are delivering approximately 60% year-two cash-on-cash returns.
So for every dollar they invest in a new store, they get 60 cents back in cash flow within 2 years.
Exactly. And they also achieve 80% opening productivity, meaning new stores generate 80% of the volume of a mature store almost immediately. These figures are world-class.
We have to acknowledge the short-term cost, though, which is cannibalization.
It's a necessary trade-off for any company committed to density. Management acknowledges the resulting 100 basis point cannibalization headwind on comparable sales. When you open a new store close to an existing one, the older store loses a point of its comp sales for a little while.
But this is an acceptable short-term trade-off.
Absolutely, the math supports it. New units outperform existing ones over time, and the cannibalized locations typically recover within a remarkably short period, 12 to 13 months.
So you're sacrificing a small piece of one metric today for a huge increase in high-performing units tomorrow.
That's the trade.
And finally, let's briefly touch on the international asset-light expansion.
This is a smart, low-risk strategy. They're pivoting to partner-operated models for global expansion.
So they can expand without deploying massive amounts of their own capital.
Exactly. They're specifically targeting growth in high-demand areas like the Middle East and Asia. Q3 saw 2 new partner-operated locations open, signaling the start of a much broader, financially de-risked international push.
This brings us to the final verdict and execution hurdles. We've defined the risk macro pressure on the core consumer and detailed the reward strategy. So the question is, how do we synthesize the investment case? Is this current situation truly a pit stop under a caution flag, or is it a permanent deceleration?
The evidence strongly suggests it is a pit stop. They're using the downtime caused by external economic forces to retool operations, reinforce their value proposition, and financially engineer a lower share count.
The pit crew is working feverishly on the car, while the caution flag is out.
That's the analogy. But the investment case hinges entirely on accepting specific near-term sacrifices. We have to assess these trade-offs honestly, starting with margin compression.
The decline in restaurant-level operating margin to 24.5% in Q3 2025, a 100 basis point decline year over year. That's the tangible price of this strategy.
And that margin pressure is a direct result of absorbing inflation, investing in HEAP, and resetting those labor incentives. Management is accepting that their profitability will look slightly worse in the immediate future because they prioritize long-term traffic health.
And crucially, they are accepting the transaction decline of -1.8%. They are refusing to raise prices to fully offset that inflation, prioritizing the long-term value mode over regaining positive transaction growth today.
So the path forward is contingent on the flawless execution of 2 parallel strategies. The first is operational and consumer-facing. successfully deploying that high-protein snack pivot, the $3.82 meat cup to recover transaction volume and frequency.
They have to turn the brand into a functional utility.
They do. And the second is financial. Simultaneously using aggressive share buybacks and high-return Chipotle expansion to shrink the share count and grow the physical footprint.
The goal being that when the economy turns, they are leaner, larger, and able to capture maximum leverage on the rebound.
It's a complex plan requiring both culinary innovation and financial discipline. The biggest execution hurdle isn't competition, but managing accelerating costs while holding the line on price to redefine that value perception.
Which leads us to our final provocative thought for you to consider. Will absorbing accelerating mid-single-digit inflation in 2026 be enough to correct the entrenched $15 price perception? Or will the value moat erode faster than the new menu innovations can drive frequency?
The answer to that tension that really defines the future growth story of CMG.
Risk defined. Portfolio protected.